Hey guys, it's Logan Freeman, Chief Marketing Officer with FTW Investments. I'm here bringing you another edition of our informational blog, or vlog in this scenario. Today I'm talking about there is an investment strategy for every investor. Let me tell you what I mean. The beauty of commercial real estate is that there's an investment strategy for investors of every risk tolerance. Really, the prudent investor is one that is able to mitigate their risk, but before they can mitigate it, they have to be able to quantify it. And so that's really, really important. Being able to make decisions based on risk-adjusted returns. Let's dive in. Commercial real estate investment strategies typically fall into one of four segments according to risk quality and potential return. We've got core, core plus, value add, and opportunistic, right? And if you think about this on a quadrant, your return is here, your risk is here, and you have kind of a swoosh. And as you can look at this, higher return is going to be opportunistic, but it's going to be also higher risk. Right below that is your value add, then your core plus, and then at the lowest return and lowest risk is your core. If you want more information on that, check the blog out. It is there. Let's talk about core. Core investments are typically low risk and require no improvements or active management. It's as close to a turnkey investment that you can get in the commercial real estate world. Along with the low risk, they also offer lower returns than the other investment types. So these are going to be lower capitalization rates. If you think about cap rates, you think about what the risk-free rate is, and then there is a percentage. There's a spread, right? So maybe it's a 4% cap rate. Well, that means that there's less risk. Typically, that means, unless it's just overpriced, that there's less risk in that investment. So these properties generate stable, consistent cash flow from established, high-quality tenants that are locked in with long-term leases. For example, a national drugstore with a 30-year triple net lease would be considered a core property. They require little to no maintenance, with most of them either being a triple net lease or a double net. The majority of expected return is generated mostly from cash flow as opposed to appreciation. Excuse me. Core Plus. This is lower to moderate risk. Annual on a historic basis, 8 to 12%. Unlike the core properties, though, Core Plus properties offer the ability to improve cash flow through slight improvement of the property or property management. By improving you can also improve the tenant profile, right? So Core Plus properties tend to be of high quality and well occupied from the get-go. Unlike core properties that are occupied by long-term established tenants, Core Plus cash flow is less predictable with more diverse tenants, and these properties require active management by ownership. A 10-year-old apartment building with a good track record or occupancy and quality of tenants in need of light upgrades is an example of a Core Plus investment opportunity. Core Plus opportunities will generate higher rates of cash flow than core properties, but some of that cash will be needed for deferred maintenance. And unlike core properties, a higher portion of the property's expected return will be generated from appreciation because of property improvements. Now, let's talk about value add. This is the biggest buzzword in the industry right now. Value add, value add. I'm looking for a multifamily property value add. Okay, moderate to high risk. 10 to 15% historic returns. Value add properties, when acquired, underperform in terms of cash flow and occupancy, but they have the potential, I love potential, to see big bumps in occupancy and rents. And as a result, cash flow once a value has been added. At an acquisition, at acquisition, most of these value add opportunities have occupancy issues, management problems, infrastructure and maintenance problems, or if you find a really good one, combination of all three. These investments require real estate expertise, strategic planning, and active management, all which FTW can do. Total expected returns are generated from both cash flow and appreciation. All right, let's talk about a level up, opportunistic. Okay, opportunistic, high risk, 12% plus historic annual returns. Opportunistic investments are the riskiest type of all commercial real estate investment strategies. These properties involve the most complicated projects like ground-up developments, land development, repositioning a building from one use to the other. Opportunistic investments typically involve dealing with entitlement, zoning, rezoning issues that can last for years. As a result, investors may not see a return on their investment for 3 or more years on these deals. Guys, one thing I want to talk about, one size does not fit all. Commercial real estate offers investment strategies for investors of all risk tolerances and timeframes. For investors seeking low-risk investments and immediate cash flow, hey, core properties would be that strategies. For investors with a long-term investment window, with a high risk tolerance seeking big potential payoffs, opportunistic properties may be ideal. We focus mostly on value add opportunities here in Kansas City. One thing I want to talk about is management. Management is key. At FTW Investments, we believe that management holds the key to investment success no matter the strategy. Incompetent management can wreck a relatively low risk core opportunity, while highly skilled management with substantial experience can turn moderate to high-risk opportunities into relatively low-risk ventures that preserve the potential for high returns. With the right infrastructure, personnel, and processes in place, the right managers can turn any opportunity into gold. With core and core plus properties, the key is to know when to push and when to stand back in order to maximize your return on investment without increasing your risk or costs due to mismanagement. On the other end of the risk spectrum, here at FTW Investments, we relish the opportunity to generate value add and opportunistic level returns at the core level risk levels with the right strategies. That is crucial. On the other end of the risk spectrum, here at FTW Investments, we relish the opportunity to generate value add and opportunistic level returns at core level risk levels with the right strategies. We believe that with strategic improvements, value add and opportunistic level properties can be turned into cash cows with minimal risk. But it all starts with incorporating the right mix of value adds that will increase the cash flow and long-term appreciation without overspending or overexertion. Strategies we incorporate for increasing the cash flow include increasing revenue, decreasing expenses, or a combination of both. Here are some typical strategies that we incorporate into our acquisitions. Adjusting rents to match market, add amenities and capital improvements, improve screening to acquire higher quality tenants, make cosmetic upgrades to enhance the curb appeal, improve the marketing, improve the property management, and for a more efficient and cost-effective operational strategy. No matter your risk tolerance, investment time frame, or property preference, there is an investment strategy sure to meet your needs. In weighing your different investment strategies and options, don't make decisions based on risk return alone. Make sure management processes the right combinations of skills, experience, personnel, relationships, and processes in order to execute the desired strategy. We have plenty of opportunities for you, and we're really excited to continue to bring you properties, to bring you videos like this, educational content. Reach out to us. Head over to our website, ftwinvestmentsllc.com. Reach out to me. I know you have my number.